Hello, my name is Brad Wagner, and I'll be discussing banking regulations. Some of the topics that will be covered are banking authority, privacy, disclosure, fraud prevention, anti-money laundering, anti-terrorism, and anti-usury lending. Banking regulation is a form of government regulation which subjects banks to certain requirements, restrictions, and guidelines. This regulatory structure creates transparency between banking institutions and individuals and corporations with whom they conduct business with. A bank's regulatory authority consists of the Federal Deposit Insurance Corporation, also known as the FDIC, the Federal Reserve Board, and the Office of the Comptroller of the Currency, the OCC. The Federal Reserve System has 12 districts centered around 12 regional Federal Reserve banks. They all carry out regulatory responsibilities in each district according to the Federal Reserve's boards. Credit unions should also follow most bank regulations and are reviewed by the National Credit Union Administration. Uniform principles, standards, and report forms were originated by the Federal Financial Institution Examination Council. In regards to customer privacy, Banking Regulation P governs the use of customers' private data. Now, banks must inform a customer of their policy about personal information and provide an opt-out before disclosing their information to a non-affiliated third party. Concerning knowing your customer rules and the Bank Security Act regulation, financial institutions generally should keep track of a customer's work status and other business ventures. The bank employee should also know the customers to ensure their transactions are in line with their profession or occupation. By knowing the customer, this allows the bank representative to notice and report suspicious activities to the government. All banks must follow the basic rules and controls in order to have financial transparency. In regards to usury lending, a loan may be considered usurious if the interest rate is excessive or unusually high. In the United States, the legal power that controls usury laws are in each individual state. Each state has a specific law that describes the maximum legal interest rate at which loans can be made. And each U.S. state has its own statute on how much interest can be charged before it's considered usurious or unlawful. The Bank Security Act. This requires banks to assist government agencies to help detect and try to prevent money laundering. Banks keep records of cash purchases and negotiable instruments on file. They report transactions that are in excess of $10,000, and that's a daily aggregate amount. And they report these suspicious activities that could be money laundering, tax evasion, or other criminal activities. Now, the BSA was originally passed by Congress in 1970, and this has been amended several times since then. And some also refer to this as the anti-money laundering law. The BSA regulations require all financial institutions to submit different types of reports to the government, depending on the situation. One example is to file a CTR or currency transaction report anytime a transaction of more than $10,000 is made, and a CTR must be filed. There's also a SAR report, or a suspicious activity report, must be filed for any suspicious transaction that doesn't seem right or may violate the law. And this is where knowing your customer comes into play. For example, if you have a retired person who doesn't have a history of wire transfers and comes in and requests several wire transfers, this may be suspicious, and one would potentially file a SARS report. The U.S. Patriot Act allows banks to limit new accounts until the institution can verify the identity of the customer. The U.S. Patriot Act was an act of Congress that was signed into law by President George W. Bush on October 26, 2001. The 10-letter backronym U.S. Patriot stands for Uniting and Strengthening America by providing appropriate tools required to intercept and obstruct terrorism. The Office of Foreign Asset Control, or OFAC, this government agency has been around for over 50 years, and it's a financial intelligence enforcement agency protecting against any national security threat. The Community Reinvestment Act of 1977 requires insured depository banks to reinvest in the communities in where they are located. This law was designed to encourage commercial banks and financial institutions to help meet the needs of the borrowers in all segments of the community, including low-income and moderate-income neighborhoods. Congress passed this law in 1977 to reduce the discriminatory credit practices against low-income neighborhoods. This practice is also known as redlining. As far as deposit insurance is concerned, in 1933, the Glass-Steagall Act established the Federal Deposit Insurance Corporation, the FDIC, to insure deposits at commercial banks. In 1970, Congress established a separate fund for credit unions, the National Credit Union Shared Insurance Fund. The NCUSIF insures all federally chartered credit unions and many state-chartered credit unions. In 1934, Congress created the Federal Savings and Loans Insurance Corporation to insure savings and loans deposits. In the 80s, during the savings and loan crisis, the FSLIC became insolvent and was abolished. Its responsibility was then transferred to the FDIC. When it comes to consumer protection, the Truth in Savings Act originated from Reg DD to establish uniformity in regards to opening new accounts and the fees associated with each account. On passing the law in 1991, it was believed that by leveling the playing field, so to speak, that new account would promote stability and provide competition between banks. This also allowed the consumers to make informed decisions with all the cards on the table. The Expedited Funds Availability Act of 1987 was implemented by Reg CC. This act defines how long banks can place holds on checks deposited in a checking account. Each individual bank's hold policy can be less than the guidelines provided, but it cannot exceed the guideline. Banks must disclose their policy to all account holders and make the policy available in writing when requested by any customer. In addition, the policy must also be provided at the time of opening all new accounts. Now, the Electronic Funds Transfer Act of 1978 was implemented by Reg E. This established the rights and liabilities of consumers as well as the responsibility of all participants in the electronic funds transfer activities. The EFT Act also provides a creditor or lender from requiring a consumer to repay a loan or credit by electronic funds transfer, except where there's an overdraft or checking plan. Home Mortgage Disclosure Act, 1975. This act requires banks and financial institutions to disclose information about home purchases, pre-approval, home improvements, and refinance applications. The Equal Credit Opportunity Act of 1974, this basically forbids banks and financial institutions from discriminating candidates on factors such as race, color, religion, national origin, sex, marital status, age, and receipt of public assistance. Now, the Truth in Lending Act of 1968, this act allowed the standardization of interest rates and other fees associated with banks among financial institutions. The Truth in Lending Act also gives consumers the right to cancel specific credit transactions when the consumer's principal dwelling may be involved. All right, in regards to debt collection, the Fair Credit Reporting Act of 1970. This act protects the consumer by limiting the sharing and use of the consumer's credit information. The act allows the consumers to obtain a copy of their credit report from the credit bureaus, and it allows the consumer to dispute negative information on their credit report. It also requires that consumers be informed when negative information is added to their credit reports. Reg O, this is loans to insiders. This regulation ensures that executive officers, directors, or principals, or shareholders, that they're not getting special loans or lower rates or loans with more attractive structures because of their position with the bank or financial institution. All right, Dodd-Frank. This was signed into a federal law by President Barack Obama on July 21st, 2010. And this was passed in response to the Great Recession. This brought the most significant financial changes to the financial regulation in the United States since the regulatory reform that followed the Great Recession. So the main goal of the DoddFrank Act is to promote the financial stability in the United States by improving accountability and transparency in the financial system, to end the, quote, too big to fail, unquote, and to protect the American taxpayer by ending bailouts and protect consumers from abusive financial practices. The Volcker Rule refers to the Dodd-Frank Wall Street Reform Consumer Protection Act. This act was proposed by the American economist and former United States Federal Reserve Chairman Paul Volcker to stop banks from making risky, speculative investments that do not benefit the customers. Volcker argued that the risky, speculative investments made by large banks played a key role in the financial crisis of 2007 to 2010. There's a list of the references used in this presentation. I want to thank you for your time and have a nice day.